All right, thanks so much everybody for joining us today for the Kay Properties and Investments 721 Exchange UPREIT exit strategy for 1031 exchange investors. This is Dwight Kay. I'm the founder and CEO of Kay Properties and Investments. And I really appreciate everybody for joining me today as we dig into the 721 exchange, to the UPREIT, what it looks like as an exit strategy for investors that are considering a 1031 exchange and the DST strategy as well. So really appreciate you jumping on the webinar here and digging in with us. Before we get started, we are going to jump into some risks and disclosures. So today we're going to be talking about, the 1031 exchange, the 721 exchange. These are parts of the Internal Revenue Code, Section 1031 and Section 721. They're part of the IRC, the Revenue Code. So we encourage investors prior to considering a 1031 exchange or a 721 exchange, prior to actually doing one of those, we highly, highly recommend that you speak with your CPA and your attorney for advice and guidance. At Kay Properties Investments, although we have CPAs and attorneys on staff here, we can't provide tax or legal advice for you. And we highly encourage you, talk to your own CPA, talk to your own attorney. We're happy to get on calls or meet in person with your CPA and attorney to help walk them through. We do that quite often, but we can't provide any tax or legal advice. Next, this is, 721 UPREIT, Delaware Statutory Trust, real estate. It's property, right? It's the underlying investment is a piece of real estate. And there's never any guarantees with real estate that values are going to go up, right? We've all seen, through the last, 20, 30 years, we've seen values of real estate go up and go down, right? In the financial crisis of 2008 and 2009, values really were affected, okay? With this recent interest rate cycle, interest rates rising so quickly, values of real estate have gone down, right? And so same for the properties that you own in your area where values can go up, values can go down. Same for with DSTs and UPREITs that you could invest in through the Kay Properties platform. Values can go up and values can go down. There's no guarantees with real estate. Same for cash flows, right? Your properties that you own in your towns, if your tenant moves out of the property, or if there's an eviction moratorium, and through COVID, we saw eviction moratoriums across the board that the CDC issued. If you can't get a tenant out of the building, if they're refusing to pay rent, there's no more cash flow from that particular unit. So same for the properties in your hometown or city or state that you own. If your tenant doesn't pay rent, or your tenant goes bankrupt, or something happens, there wouldn't be any cash flow that month. That's the same for the 721 UPREITs, for DSTs. It's all real estate. So you have all the same risks in DSTs and UPREIT strategies as an investor as you do with owning your own property. And so we encourage investors, read the private placement memorandum, walk through it, read through it, understand the business plan of the offering, understand the risk factors of investing in real estate, ask us questions. We'll walk you through the potential pros and cons. So those are just a couple of the risk factors that we wanted to discuss here. And then also the last two: diversification does not guarantee profits or guarantee protection against losses, and past performance is not indicative of future returns. Potential cash flows, returns, appreciation are not guaranteed and could be lower than anticipated. So jumping in here, this is the Kay Properties Investments overview. I'm going to do a quick overview just to set the stage, to let you know who we are, what we do, how we help our clients throughout the country. For nearly 2 decades, we've been helping investors review and understand 1031 exchange strategies and DST investments. Okay, so that's what we do at Kay Properties Investments: real estate investments, 1031s, DSTs. I was fortunate and blessed to actually write the first book that ever was written on Delaware Statutory Trust investments. And so that kind of, I started back nearly 2 decades ago as a property review analyst. Before that, I was in commercial brokerage. But as a property review analyst at a broker dealer, and essentially going through the DSTs and the various real estate offerings, looking at the sponsor's PPM, the sponsor's projections, looking at the appraisals, the environmental reports, the property condition reports, really going through and understanding, does this make sense for an investor, right? There's always risk in any real estate or investment, but does it make sense? And so that's kind of how I started. My first DST that I personally invested in was in 2008. So before pretty much everybody that sells DSTs now in today's market, they're usually sold by financial advisors that do 1 or 2 a year, and they, help their investors with stocks, bonds, mutual funds, life insurance. Before any of them even knew that they existed, I was actually personally investing in a DST in 2008. So fast forward, I have almost 100 DST investments that I've done with cash investments as well as 1031 exchanges. These are with many different sponsor companies. So that's a big, in my opinion, bonus for our investors. Is not only have we helped over 2,200 clients nationwide purchase over 9,000 DST investments and advise them on that, but I personally have put my family's dollars into these things, over the years since going back to 2008, and that's with many different sponsors that I've invested with. So that it brings to our clients an experience level that not a lot of people have. And so we're really proud of the fact that we can bring that experience to the table, walk investors through, the various options available, and then from there, go through the pros and cons, the potential risk factors, and help them make an informed decision, right? Because unfortunately, if you're a financial advisor and you do 1 or 2 DSTs a year with, one company, you might not even know the backstory of that company, their history, their track record, how they've performed over the years. All you know is what the shiny marketing brochures tell you about that company and the investment, where we really know the backstory from this vast experience. So participate in over 39 billion of DST investments. So the KPI1031.com platform, that's going to provide access to the marketplace of typically 20 to 40 DSTs from over 25 different sponsor companies. At K Properties, we work with all the major sponsor companies in this space. We don't offer every single one of their offerings. If there's a deal that comes out that we think this one probably is going to be a great deal, probably work out fine, but we don't like it for some sort of reason, and there's a number of reasons why something may not make it onto our platform, we're not going to offer it. Still might be a great company, still might end up being a really great investment, but if we're not comfortable with it, if I wouldn't invest in it, then we're not going to put it on the platform. Okay, so at K Properties, we work with all the major groups, Pasco, Inland, Cantor Fitzgerald, Apollo, Invesco, Blue Rock, all these various sponsor companies. We look at their offerings, we review their offerings, and we put them on the KPI1031.com platform for investors to review. So when you register at KPI1031.com, you're going to get access to all of these sponsor companies that we have available and their offerings. Okay, and a lot of those do have a 721 exchange component that we will walk you through. Okay, so that's a little bit about K Properties. Jumping into it here, the 721 exchange UPREIT, it's an exit strategy for 1031 exchange investors. So first off, what is a Section 721 exchange? First off, the Section 721 exchange of the Internal Revenue Code states that no gain or loss will be recognized when property is contributed to a partnership in exchange for an interest in the partnership. Okay, so you're taking a property and you're contributing it to a partnership, and it's tax deferred under Section 721 exchange. So that's the same as a 1031 exchange, very similar, where when you take a property that you've held for investment or business purposes and you sell it and reinvest the proceeds into another property that you're using for investment or business purposes, if you follow the 1031 exchange rules, you're going to have a fully tax deferred exchange. That's the same with the 721 exchange, except for you're contributing the property to a partnership in exchange for interest in the partnership. So that's basically the 721 exchange. There's a two-step process that pretty much every single one of the 721 exchange opportunities in this space right now works through. Okay, so first off, you're going to take your relinquished property, and our clients at K Properties, many of them own 5, 10, 15, 20 unit apartment buildings. A lot of them own, portfolios of single family homes. A lot of them own, commercial buildings, warehouses, hotels, you name it, farms, ranches, all over the country, right? We've helped over 2,000 investors with their exchanges. And so essentially, the investor is selling their property. Their 30 unit apartment building, they're going to have 5 million of equity coming out of that sale. Okay. They're going to sell their property and set up a 1031 exchange with a qualified intermediary or an accommodator. Okay. So you're going to sell your property. The funds go to your qualified intermediary. And K Properties, we're not a qualified intermediary. Okay. That's not what we do. We decided we really wanted to focus on helping people with solutions and the DST process. We're not trying to do a whole bunch of different things. So we're not a qualified intermediary, but we work with many of the national qualified intermediaries that can help you, and we're happy to provide references, send those over to you, ones that have helped hundreds and hundreds of our clients. So you sell your 30 unit apartment building, you set up the 1031 exchange paperwork. The $5 million, it can't go to you. If it goes to you, that's constructive receipt. You have a taxable event. It has to go to your qualified intermediary. From there, your $5 million, you're deciding, okay, I'm going to exchange into these Delaware Statutory Trusts, okay? So you're purchasing interest in a Delaware Statutory Trust. And, on the KPI1031.com platform, again, we have, 25 different sponsors. Probably right now, about 10 of them have a 721 exchange, planned exit strategy. Okay. Others have a potential 721 exchange plan exit strategy, and we can walk you through that. Excuse me. But as an investor, you're working with the K Properties team. We're showing you the different options that are available that you could go into the DST, and then from there, after a period of time, typically 2 years, you exchange, call it $1 million into one of the DSTs. 2 years later, that 721 exchange is going to take place. And that what happens is interest in the DST, okay, so your $1 million interest in the DST is contributed on a tax deferred basis to the 721 exchange vehicle's operating partnership in exchange for operating partnership units. Okay, so going back, you sell your building or your piece of land or your apartments or your single family rental, you sell that, you exchange into a DST that has a 721 exchange planned exit strategy. And then about typically 2 years later, that DST interest is called into the operating partnership of that larger REIT, okay? So you're contributing your DST interest for operating partnership units on a tax deferred basis. So it's kind of a two-step process there. So again, this structure allows holders of a DST interest to exchange their DST interest for economic interest in the 721 vehicle in the form of operating partnership units by contributing that property to the partnership in a 721 exchange, okay? So again, the DST property is contributed to the operating partnership. Now you're in a diversified portfolio of properties. From there, you're on a tax deferred basis receiving operating partnership units instead of your beneficial interest in a DST. So why do investors utilize the 721 exchange? First reason is tax advantages. When real estate is typically sold, an investor pays taxes on the capital gains realized as well as depreciation recapture. And that leaves an investor with less capital for reinvestment. With the 721, the investor can avoid this hefty tax through a tax-deferred exchange of real estate or interest in a Delaware Statutory Trust for shares in an operating partnership. Capital gains can be deferred until the investor sells the OP units, converts the OP units to REIT shares, or the contributed property is sold by the acquiring operating partnership. So you're deferring your capital gains just like in a 1031 exchange, defer, defer, defer. You're also deferring your capital gains with the 721 exchange. And then a lot of people use it as a estate planning tool for their heirs as they're thinking about, I don't want my kids to have to deal with future 1031s or, figure out, do they want to sell the property or not? I'll do this, and then the shares of that operating partnership are divisible pursuant to your trust and your will. So Another reason is diversification. I first start out with diversification does not guarantee profits or guarantee protection against losses. There's no guarantees. That's why we encourage diversification, because you don't want to, over concentrate into one property. I mean, I can't tell you how many times our investors come to us and they may have a commercial building or an apartment building or whatever it may be, and it's that asset is 30, 40, 50, 60, 80, 90% of their net worth in that one property. And diversifying out of one property in one location, one town or city, it's really important. I mean, we just saw our headquarters at Kay Properties were in Torrance, California, not far from the Palisades fire. We just saw a massive natural disaster there, and diversifying is something that many investors are keenly interested in today's market, but it doesn't guarantee profits or protection against losses. So the concentration risk of owning one property in a single market, the 721 vehicle tends to own many assets diversified through different markets. It can provide greater diversification for an individual's portfolio, which can reduce potential concentration risk. So for example, instead of owning, first off, let's go back to the $5 million 30-unit apartment building. Instead of having 30 units in Los Angeles or Miami or New York City or Dallas, wherever you're at, right? Or maybe it's 4 units, right? I mean, and let me back up. We help clients do the 1031 DST strategy as well as the 721 exchange strategy with as little as $50,000, $100,000 in their exchange. And then we've also helped clients that have invested 50, 60, $100 million of equity, selling large holdings, large warehouses, large apartment portfolios. So we help clients across the board. And that's something that we really, are focused on, is giving even smaller investors the same exact level of service as our largest investors. And so, and by the way, we have thousands of clients that have done this with us over the past nearly 2 decades, and we can absolutely provide references to those investors, the large and the small, to vouch for what we're saying here. Is we treat everybody the same because each investment is important to that person, and every person is the same. So, so going back, that 30-unit apartment building, $5 million of equity coming out of it, when that investor sells that and goes into a portfolio of DSTs, maybe 5 different DSTs at $1 million each to diversify, that's reducing concentration risk right there, okay? And then from there, maybe that $1 million DST, this right here, it says 500,000, but call it $1 million, that DST interest in one building, this is a FedEx leased industrial building. We have a number of FedEx leased industrial buildings for our investors. They've done a very good job at providing a predictable, durable income stream for our investors over the past. Obviously, past performance doesn't guarantee future results. FedEx could go out of business. They're one of the largest companies in the world. We don't think they will, but it is a risk. But you're able to diversify from that $5 million 30-unit apartment building in one city. Now you own 5 different DSTs in different cities, different asset classes, different locations. Then even from there, that DST interest is now 721 exchange into a diversified portfolio containing over 2 million square feet of industrial, multifamily, retail, medical, mixed-use properties with many different tenants like FedEx, Amazon, Frito-Lay, Fresenius, DaVita, and many, many more, right? These are some of the largest companies in the world. So you go from one building, 30 units, to a 1031 into 5 different DSTs with, maybe instead of 30 units, you're in, 1,000 apartment units, you're in, 400,000 square feet of industrial distribution facilities, and other asset classes. So you're diversified there. And then from there, the 721 gets you even further diversification. So next, why do people like the 721 exchange? Income potential. So income potential is really important to investors. Like I said, real estate, there's no guarantees for income or distributions because it's real estate. The tenants have to pay the rent in order to have that distribution, that income, right? So, but that's why you want to really focus on properties that make a lot of sense to you as an individual and what's going on in the market, right? A lot of our investors over the years, income is very important to them. And so there's certain asset classes that we don't participate in because income can be affected in a macroeconomic situation. And so, and there's certain tenants that we steer clear from because we really want to do our best to protect our investors' income potential. There's no guarantees, but there's certain real estate and DST offerings and 721 exchange offerings that don't make sense for an investor that wants to protect that income potential. So, but because income is one of the reasons that investors like the DSTs and the 721 exchange. So the 721 vehicle, once you're in there, it's going to have the goal of increasing income potential to investors over time through accretive acquisitions, so acquisitions that are beneficial to the portfolio as a whole, and portfolio optimization. So repositioning, redeveloping an asset in that 721 exchange vehicle for enhanced income potential that flows through to investors. So investors will enjoy income potential that is tax advantaged via depreciation and other write-offs to help shelter distributions. So income potential, appreciation potential. So investors are able to participate in potential appreciation realized at the individual asset level as well as at the enterprise value level, the entire operating partnership or 721 vehicle. The 721 vehicle will be positioned to take advantage of market opportunities via acquisitions designed to potentially enhance shareholder value, right? If you exchanged into a DST and a 721, 3 years ago, well, that was one transaction, right? But as that goes into the REIT, now the REIT is constantly buying into the new market, new pricing. And so that can be a potential benefit for investors. Liquidity potential, this is an important one. So the 721 exchange vehicle may provide investors with the option of liquidity on a partial or full basis. There's no guarantee for liquidity, right? These large REITs and various groups that provide these 721s, they can and they have shut down the liquidity provision at various times. So there's no guarantees for it, but it is an option for investors, a potential option that they can utilize. So investors would have the option to liquidate a portion of their shares in combination with their tax planning strategies. So you might do a 1031 into a DST for $1 million. From there, that goes into the 721, and then at that time, you may start liquidating a portion of your OP units in order to receive liquidity. Maybe a couple $100,000 at a time, or you don't have to take that entire tax hit in one situation. So liquidity is a feature that many investors may never need or desire. However, knowing that it is available provides peace of mind and options for investors. So it's important, every 721 vehicle, the liquidity feature is different, and it may be limited in certain circumstances. So please read the offering material in full for a discussion of the 721 vehicles liquidity program. We can walk you through that, ask us questions on it. They're all different, a little bit different, and it's important to know that. At the end of the day, it's important for investors when they're doing DSTs or 721s to understand this is real estate. There's no guarantees for liquidity in real estate, right? It takes time to sell a piece of real estate. It's the same with DSTs and a 721. Any liquidity potential, it's never guaranteed, okay? Another question as to why investors utilize the 721 is estate planning. So upon the death of the owner, OP units can be equally split and either held or liquidated by the beneficiaries of the trust. So beneficiaries receive a step up in basis and can avoid capital gains taxes and depreciation recapture tax. So similar to a 1031, you defer, and then you pass, and your heirs get that full step up in basis. Same for the 721. You defer through your 1031, then you go into a DST that goes into a 721, again, deferred, and then when you pass, your heirs get that full step up in basis. So this allows investors to plan for the future with the opportunity to transfer wealth to heirs in a tax efficient manner and allow for individual flexibility when liquidating. So a hypothetical case study here. Say an investor owns a $150,000 interest in a debt-free DST. And just to clarify, at Kay Properties, because we provide you through the KPI1031.com direct access to all the different sponsor companies that we work with in the industry, you as an investor are able to see what's available in terms of debt levels and loan to values, right? On the Kay platform, probably 60–70% of the offerings that we have loans on them for those that need to replace debt in their 1031 exchanges. They've got to purchase equal or greater value in the 1031 exchange to avoid a tax liability. So we have that for you. And the debt is non-recourse, it's prepackaged. Typically it's long-term, typically a 10-year loan. And so we have that for you, but then we also have debt-free options that a number of the sponsors put together for those that don't want the risk of debt, okay? This instance, it's a debt-free DST, $150,000 interest, owns a single tenant net lease FedEx distribution facility DST. By completing a 721 exchange into the 721 vehicle, the investor potentially benefits from full tax deferral via the 721 exchange, diversification. Instead of an interest in just one property, now owns an interest in a portfolio of, say, 2.1 million square feet, and 80 to 100 properties. You have tenant exposure in multiple states, okay? In this hypothetical scenario, 33 states. Upside potential. Investor now has the ability to participate in the entire portfolio's appreciation potential and enterprise value. Income stream protection and enhancement. The investor now has many diverse streams of income from multiple tenants, buildings, asset classes, and geographic locations. Increased income potential. The 721 vehicle will have the goal of increasing income potential to investors over time through accretive acquisitions, dispositions, and portfolio optimization. Tax benefits. Investors will enjoy income potential that is tax advantaged via depreciation and other write-offs to help shelter distributions. Liquidity potential. The investor now has the ability to liquidate a portion or all of their shares at their discretion, subject to the fund liquidity provision as set forth in the PPM. Again, no guarantees on liquidity, and we can walk you through out of the 10 different 721 vehicles that we have available from 10 different sponsors on the KPI1031.com platform. Some of the largest names in real estate, by the way, that we have their offerings on the platform that you can review. We'll walk you through the potential pros and cons for each of them and show you, what their liquidity provisions are. But again, it's never guaranteed. And then estate planning benefits. Upon the investor's death, OP units can be equally split and either held or liquidated by the beneficiaries of the trust. And as well as the beneficiaries will receive a step up in basis, allowing them to avoid capital gains taxes and depreciation recapture taxes. So that's essentially the 721 in a nutshell. There's some deeper things to look into when you're going into a DST that has a planned 721. Some of the things that I personally look at as I'm considering these, and we encourage you, is we want to look at, well, first off, just because it's a large name sponsor with a large REIT doesn't mean that you don't need to look at the actual property that the DST that you're exchanging into. Because how these work is that the REITs have an option, but typically not an obligation to offer those DST investors a chance to 721 their DST into their REIT. So if all of a sudden, okay, kind of hypothetical scenario, say property values drop by 40%, do you think that REIT and that large institution is still going to want to bring that DST into the REIT and drag down the value of the REIT? They very well may not, okay? So I always say, look, you want to look at that property and know I'm an owner in this DST. I know that they have a plan to go into the REIT, but I have to be very comfortable in that DST, what it looks like, where it's located, who the tenants are, the asset class, the financing on it. I really need to be comfortable with that because I very well may not end up going into the REIT or having that obligate or the opportunity to go into the REIT. So that's number one. Number two, I want to look at the debt levels of the actual REIT. You know, some of these REITs have modest leverage of 30, 40%. Others have a little higher leverage, right? Others are debt free. Okay. So one of the things that I look at is, okay, am I okay with the financing on the final destination, that REIT that I would be 721 exchanging into, right? We often see investors being, sold a story about this sponsor is one of the largest and they're going to do the 721 here. And they look at the DST, and the DST might be debt free, but then once it goes into the 721 vehicle, that REIT might be 50, 60% loan to value. And the investor really should ask themselves, do I want to be, if I'm debt free now, do I want to be in a REIT that has a bunch of debt on it? Okay, and maybe they do, maybe it makes sense, but that's something I look at. I also like to look at, in the 721 vehicle, what kind of properties are in there. If it's a 721 REIT with a bunch of, assets that I wouldn't want to own personally, a bunch of hotels or a bunch of senior care facilities, not because they're bad, but because they're more volatile and you have higher risk potential with those asset classes. I probably wouldn't want to go into a DST that's going to 721 into that REIT, right? So really you want to look at the actual assets that are in the 721 vehicle that you will ultimately likely be a part of, okay? So those are just a few of the things that I look at. Also, I want to look at, does that REIT have a bunch of floating rate debt? Do they have, a bunch of credit facilities that are very expensive? 3 years ago, those credit facilities were a godsend because it was cheap money and everything was great. But now, as interest rates have gone up drastically, are those credit facilities, are they a drag on the entire portfolio? I want to look at that. I want to also look at the adjusted funds from operations and see, is the distribution that is being paid to the REIT investors, is that distribution being fully covered, or at least mostly covered by the adjusted funds from operations? Some of the REITs out there, the 721 vehicles out there, it is. Others, it's not. And doesn't mean, if they're not, that they don't have a plan and that they're bad, but it's something to be aware of as an investor, okay? And this is the kind of stuff that we have, been exposed to over nearly 2 decades of working with the largest REITs in this type of, vehicle in this space, and the largest sponsors in this space, and understanding, hey, what makes sense for our investors? Not just, oh, my broker dealer or RIA, they did their homework on it and they said it was good. No way. We want to look at the actual properties. We want to look at the actual REITs, understand, where are we at with this? And then from there, we want to diversify. We see all too often some financial advisor or somebody that says they're an expert here encourages the clients, but their full $1 million or their full $20 million into one company's 720 or DST, which is going to be in one 721 vehicle. And guess what? That thing may have some red flags on it. And so they over concentrate into one REIT. If you look at the public REIT markets, they're volatile. Okay, the perpetual non-traded REITs out there, they're obviously not listed that you'll be 721 exchanging into, but over the years, there have been losses in these REIT vehicles. So why in the world would you take $20 million or $1 million or 500 grand, if that's your whole exchange, and go into the single 721 vehicle just because it's somebody told you it's the best, it's a big name, they're in the news a lot? Absolutely not. You want to diversify and have a position in 3 or 4 or 5 of these things that are well thought out, make sense, you understand it, and that's what we do at K Properties. So because again, there's no guarantees in UPREITs, DSTs, or in real estate. You can lose all your money in real estate, DSTs, and 721s. You can. So you got to be really careful. You got to be really smart and very deliberate in what you do. So if you visit the KPI1031.com marketplace, you're going to get free access. And send your CPAs here, your attorneys here. We'll get them access as well. If you have kids that need to, know kind of what you're doing and thinking about, send them here. We'll get them access as well. KPI1031.com. We'll get you access to our marketplace of 721 exchange UPREIT opportunities. Okay, you'll get a listing menu of debt-free as well as, like I said, leverage, typically 30 to 50% loan to value, DSTs for those that need debt replacement in their exchange, and that's available for 1031 exchange. So typically 20 to 40 different DST offerings of debt-free and leverage DSTs, and then you'll have access to the marketplace of DSTs from over 25 DST sponsor companies. Okay, so that's, groups like, Invesco, Apollo, Cantor Fitzgerald, Blue Rock, Capital Square, Exchange Right, Inland, all these sponsors out there. You'll be able to compare and contrast their offerings. We'll be able to help walk you through the potential pros and cons. If they're on our platform, they're groups we've worked with, and they're good groups, but not every deal that they come out with we're comfortable with. Okay, may ended up being really good, but we're really looking for potential red flags and helping to guide our clients. So that's what we do at Kay Properties. We've got a full team that specializes in this day in, day out. That's how we've helped thousands of investors. And we've been told by many of these sponsors that we are the biggest DST shop in the entire United States. So we're blessed, and I give thanks to God for that. So to be able to help so many people and then turn around and help others with that success. So register today. You'll get access to 721 exchange and DST offerings at kpi1031.com. Also, you'll get a free book on DSTs. That's the book that I wrote. It was the first book on DSTs. It's got a chapter on 721 exchanges. First one ever written. We have a subscription to the 1031 DST Digest magazine. A lot of, thought leadership articles on 1031s, DSTs, 721 exchanges. So very educational. It's a great piece for investors. You'll get access to our weekly Friday conference calls on 1031, 721s. You'll get access to our weekly webinars like this one. Make sure to invite you to those. And then also we have coming up here, we have our K Investor Day. And what that is, and we're based in Southern California. A lot of the sponsors in this space are based in Southern California. And so what we do at the K Investor Day is we have clients from all over the country flying in, and they essentially coming to our K Investor Day and hearing presentations from us and kind of what we do, our process, how we look at these things. And then we have, 4, 5, 6, 7 of the different sponsors that we work with. Okay, they're going to be talking about their companies, what helps them stand out, what differentiates them, what their background is, their story, their track record. Obviously, again, past performance doesn't guarantee future results. So I always take it with a grain of salt, and really, somebody might have a great track record, but if the deal that they're showing me, I don't feel comfortable for one reason or another, I'm not going to do it. I don't care about the track record, because the track record is from different deals than the one that I'm being offered to invest in. So, but the K Investor Day, you're going to get exposure to some of the largest sponsors in the space and some of the most specialized sponsors in the space that, have done a great job for our clients over the past. And so ultimately, for those investors that are in 1031 exchange, especially if it's a larger amount of capital, we encourage you, when you reach out, ask us about K Investor Day. We'll get you on the list. Come out here, fly out here. We've got clients from, I want to say it's probably not all 50 states. There's probably 1 or 2 states, but many of the states in the country, investors that invested with us for years, and coming and seeing us and taking part in K Investor Day, you're really going to gain a lot of knowledge that if you're thinking about DSTs and 721 exchanges, it really would behoove you to join us at those and learn more. So just sign up at kpi1031.com. And with that, our entire team, we're here to assist you. Anything you need, call us. I'm also available for calls at any time, or Zooms, or in-person meetings. Our president, Shay Lapin, he is as well. And we really appreciate the time that everybody's taken today. So hope that everybody has a wonderful rest of their day. Thanks so much.